This is OwlUp, where learning happens in minutes, not hours. For a deeper journey, explore all our courses at owlup.co. Now, let's dive in. Welcome back to First Time Homebuyer, the complete roadmap. This is Chapter 2, and today we're diving into the world of home financing and breaking down all the different types of mortgages you'll encounter on your house hunting journey. We'll help you make sense of fixed rate versus adjustable, conventional versus government-backed loans, and everything in between so you can figure out what works best for your situation. Let's get into it. About half of first-time buyers put down far less than the classic 20%, and many only learn that at the closing table. In this episode, we drop you right into that moment and rewind. How did the loan, the rate, and the fine print all come together? In 2024, roughly 3 in 10 first-time buyers are using government-backed loans without realizing how different they are behind the scenes. That choice can quietly shape everything from how soon you can move in to how easy it is to refinance later. Today, we're stepping past the "how much can I afford" question and into the machinery that decides who says yes to you, on what terms, and how fast. We'll look at how your credit profile is sliced into tiers, why one lender might shrug at a late payment while another treats it like a red flag, and how rising rates have turned timing into a strategic decision rather than a lucky break. Think of this as walking through a gallery of loan options. Same destination, owning a place of your own, but very different frames, lighting, and price tags once you step closer. Think of today as stepping behind the counter instead of standing in line. You already know you'll be judged on paper. Now we'll zoom into how that paper gets stacked and rearranged. Lenders don't just see a lump sum, they see streams. Income flowing in, debts flowing out, and savings as a reservoir that rises and falls. As rates have climbed, the shape of those streams matters more. Side gigs, bonuses, and even how long you've held your job can tilt the decision. We'll also explore how different lender types plug this same data into very different playbooks. Lenders start by sorting you into broad buckets: the property, the loan type, and you. The property sounds boring, but it quietly changes everything. A condo with a thin homeowners association budget, a duplex you'll partly rent out, or a manufactured home can each trigger extra scrutiny, tighter rules, or higher pricing. Two offers on the same street can get different terms simply because one building fits a lender's comfort zone and the other doesn't. Next comes the structure of the loan itself. Fixed-rate loans dominate because they're straightforward to price and sell to investors, but there are micro-choices inside that label: 30-year versus 20 or 15-year terms, slightly higher rates in exchange for lower closing costs, or the option to pay points to push the rate down. Adjustable-rate loans stack on top of that with extra dials: how long the initial fixed period lasts, how often the rate can move, and how big each jump can be. Then there's how your application moves through a lender. Some route you almost entirely through automated underwriting systems. If your profile fits the model cleanly, you can go from application to conditional approval in hours. Others rely more on human underwriters who can weigh context, like a recent career change into a higher-paying field, but may move slower and ask for more documentation. Fees are the underappreciated third rail. Origination charges, lender credits, rate lock fees, and pricing adjustments for things like smaller loan amounts or multi-unit properties all get baked into a maze of line items. Two identical advertised rates can differ by thousands of dollars when you zoom into the closing disclosure. Finally, lenders don't all treat risk the same way. One might specialize in borrowers with thinner files or non-traditional income and charge a small premium. Another might price aggressively for ultra-clean profiles and pass on everyone else. In practice, that means a no at one place can be a yes somewhere else, with the same overall payment once you balance rate and fees. A pre-approval letter is like your ticket onto the playing field, but the way you got it matters. A fully documented pre-approval, where an underwriter has already reviewed your pay stubs, tax returns, and bank statements, can beat out a higher offer backed by a flimsy pre-qual based on self-reported numbers. In a multiple offer situation, listing agents often call lenders. A responsive loan officer who can clearly explain your file becomes a quiet advantage you never see on paper. The fine print around rate locks is another spot where details change outcomes. A 30-day lock might be cheaper, but if your appraisal is delayed, you could end up paying an extension fee or relocking at a worse rate. Stretching to a 60-day lock can cost a bit more upfront, yet save thousands if rates bump up before closing. Your lender's tech stack also shapes your stress level. E-signature closings, appraisal waivers, and automated income verification can shave weeks off your timeline and cut down on "we still need one more document" emails. AI-driven tools will quietly change how you fit in the system. Instead of a single snapshot, underwriters may see your finances more like a time-lapse video, patterns in how you handle cash flow, not just where you stand today. That cuts both ways. Steadier habits could unlock better terms, but volatile behavior might count more against you. Your challenge this week: review last year's statements and ask, if this were scored as a pattern, what story would it tell? Instead of treating financing like a one-time hurdle, think of it as a lever you can keep pulling. You can refinance if terms improve, recast after a big lump sum payment, or strategically pay extra on principal when cash flow allows. Your challenge this week: sketch 2 future you scenarios, one conservative, one bold, and outline how your loan could flex for each. This was OwlUp, your daily step forward. To keep learning with structured courses and more insights, go to owlup.co. Until tomorrow.